Hello students. So today let me discuss about placement of the issue in primary market. Then let me discuss about secondary market, its functions, history of stock exchange, then the regulators of the secondary market and the members and brokers on the stock exchange, how the trading happens in secondary market, how settlement takes place in secondary market, and about stock market indicators. To start with, let me start with the types of placements in the primary market. So initially, initial issues are floated in the primary market, and the different types of flotation in primary market is offer through prospect, bought out deals, offer for sale, private placement, rights issue, book building. And to start with, what is offer through prospect? So what do you mean by prospectus? According to Companies Act of 1985, application forms for shares of a company should be accompanied by the memorandum, which is called as abridged prospectus. That is, in simple terms, a prospectus document, it gives details regarding the company and it invites offers for subscription or purchase of shares or debentures from the public. And this prospectus, that is the draft prospectus, has to be sent to the regional stock exchange where shares of the company are to be listed, and also to all other stock exchanges where shares are proposed to be listed. The stock exchange scrutinizes the draft prospectus. After the scrutiny, if there is any clarification required, the stock exchange writes to the company and suggests modifications if any. And prospectus should contain details regarding the statutory provisions for the issue, program of public issue opening, closing, and earliest closing date of the issue. And the issue to be listed at. It highlights the risk factors, the capital structure, board of directors, registered office of the company, brokers to the issue, brief description of the issue, cost of the project, projected earnings, and all other such details. The board, lending financial institutions and stock exchanges in which they are to be listed, should approve the prospectus. And then it is distributed among the stock exchanges, brokers, underwriters, collecting branches of the bankers, and to the lead managers. And some of the features of prospectus are, it should contain general information like the name and address of the registered office of the company, the names of stock exchanges where applications have been made for permission to deal in the permission to deal in, and for official quotations of shares and debentures, opening and closing and earliest closing dates of the issue, name and address of lead managers, name and address of trustees under debenture trust deed, rating for debenture preference shares, if any, obtained from CRISIL or any other recognized rating agency. And with respect to capital structure of the company, it should contain the issued, subscribed, and paid up capital amount, size of the present issue, giving separately reservation for preferential allotment to promoters and others, and about paid up capital after the present issue, after conversion of debentures, and details regarding the promoter's contribution should be mentioned. And it also should contain the terms of the present issue like authority for the issue, terms of payment, procedure and time schedule for allotment, issue of certificate and rights of the instrument holders, how to apply, that is availability of forms, prospectus and mode of payment, special tax benefits to the company and shareholders under the income tax, if any, income tax act, if any. It also should contain about particulars of the issue, that is object of issuing the prospectus and raising the capital, the cost of project, means of financing, which includes promoters' contribution. Then it should contain information about company management on project, like the history of the company, main objects and present business of the company, subsidiary of the company, if any, promoters and its bag and their background, the name, address, and occupation of the managing directors and other directors, including nominee directors and whole time directors, location of the project, plant and machinery, technological process, etc. Collaboration, any performance guarantee or assistance in marketing by the collaborators. Infrastructure facilities for raw materials and utilities like water, electricity, etc. Schedule of implementation of the project and progress so far, giving details of land acquisition, civil works, installation of plant and machinery, trial production, consumer production, the product, that is about the products, nature of the products, what kind of consumers, the industrial and the end users, approach to marketing and proposed marketing setup, export possibilities and export obligations, if any, future prospectus of the company, expected capacity utilization during the first 3 years from the date of commencement of production, and the expected year when the company would be able to earn cash profit and net profit, stock market data for shares, the ventures of the company, about the high price, low price in each of the last 3 years, and monthly high, low during the last 6 months, wherever applicable. Particulars regarding the other listed companies under the same management which have made any capital issues during the last 3 years. Details of the outstanding litigations pertaining to matters likely to affect the operations and finances of the company, including disputed tax liabilities of any nature and any other default and criminal prosecution launched against the company. Management perception of risk factors like sensitivity to foreign exchange rate fluctuations, difficulty in the availability of raw materials, or in marketing of products, cost, time overrun, etc. Justification of the issue premium, the justification for prices given taking into account parameters like performance of the company as reflected by earnings per share and book value of share for the past 5 years, future prospectus, future projections in terms of earning per share and book value of share in the next 3 years, stock market data, net asset value as per the latest audited balance sheet. If the projections are not based on the past data, appraisal made by a banker or financial institution should be specified. Uh, then financial information, that is financial performance of the company for last 5 years should be given from the audited annual accounts in the tabular form. Balance sheet data like equity capital, reserves, and borrowings, profit and loss account data in terms of sales, gross profit, net profit, dividend paid, if any, and any change in the accounting policy during the last 3 years and its effect on profit and reserves of the company. Statutory and other information like minimum subscription, details of the fees payable to advisors, registrars, managers, trustees of the debenture holders, and underwriters, details regarding the previous issues, if any. So, prospectus should contain all these details, and a draft prospectus has to be sent to the registrar for approval, registrar and SEBI for approval. And the next type of placement of issue is book building. What is book building? When a company is not sure about what prices to be fixed for the shares, it follows a process of generating, capturing, and recording investor demand for shares during an IPO or other securities issue. That is what is called as book building. Book building, it is a mechanism through which the initial public offerings takes place in the US, and similar mechanism are used in primary market offerings. In the process, the price determination is based on orders placed, and investors have an opportunity to place orders at different prices as practice in the international offerings. The recommendations given by Malagam Committee paved way for the introduction of the book building process in the capital market in the year 1995. Among the lead managers or the syndicate members of the issuers or the merchant bankers, a member is nominated by the issuer company as a book runner, and his name is mentioned in the draft prospectus. The book runner, he has to circulate the copy of the draft prospectus to be filled with SEBI among the institutional buyers who are eligible for the allotment. The draft prospectus should indicate the price band within which the securities are offered for subscription, and the offers are sent to the book runners. He maintains a record of the names and number of securities offered and the price offered by the institutional buyer within the placement portion. And underwriters should also intimate the orders received by them within the placement portion and the price for which the orders is received to the book runners. And then the price is finalized by the book runner and the issuer company. The issue price for the placement portion and offer to the public should be the same. And underwriting agreement is entered into after the fixation of the price. One day earlier to the opening of the issue to the public, the book runner will collect the application forms along with the application money from the institutional buyers and the underwriters. The book runner and other intermediaries involved in the book building process should maintain records of book building process, and the SEBI has the right to inspect the records. The next type is private placement. In this method, the issue is placed with a small number of financial institutions, corporate bodies, and high net worth individuals. The financial intermediaries purchase the shares and sell them to investors at a later date at a suitable price. The stock is placed with the issue house client with the medium of placing letter and other documents which taken together contribute a prospectus giving the information regarding the issue. The special feature of this type of placement is there is no need for underwriting arrangement since the placement itself amounts to underwriting. The terms of the issues are negotiated between the issuing company and the purchasing intermediaries. Listed public limited company as well as closely held private limited company can access the public through the private placement method. Mostly in the private placement, securities are sold to financial institutions like Unit Trust of India, mutual funds, insurance companies, merchant banking subsidiaries of commercial banks, and so on. Bought out deals, it is also called as offer for sale. Here, the promoter places his shares with an investment banker who is called as bought out dealer or sponsor who offers it to the public at a later date. In other words, in a bought out deal, an existing company offloads a part of the promoter's capital to a wholesaler instead of making a public issue. The wholesaler is invariably a merchant banker or sometimes just a company with surplus cash. In addition to the main sponsor, there could be individuals and other smaller companies participating in the syndicate. The sponsors hold on to these shares for a period and an appropriate date they offer the same to the public. The hold on period may be as low as 70 days or more than a year. In a bought out deal, pricing is the essential element to be decided, and bought out dealer decides the price after analyzing the viability, the gestation period, promoter's background, and future projections. Bought out deals sheds the shares at a premium to the public, and if the issuing companies goes for this option, it has many advantages, like a medium or small sized company which is already facing working capital shortage cannot afford to have long lead time before the funds could be mobilized from the public. Bought out deal will help the promoter to realize the funds without any loss of time. Also, the cost of raising funds is reduced in bought out deals. For issuing shares to the public, the company incurs heavy expenses which may invariably as high as 10% of the cost of the project. It is also advantageous that bought out deals will help the entrepreneurs who are not familiar with the capital market but have sound professional knowledge to raise funds. Sponsors of the deal are mostly concerned with the promoter's background and government policies than about the past track record or financial projections, which helps the new entrepreneur to raise adequate capital from the market. For a company with no track record of projects, public issues at a premium may pose problems as SEBI guidelines come in the way. The stipulations can be avoided by a bought out deal. Companies sell the shares at a premium to the sponsors and they can offload the shares to the public at a higher premium. Finally, to the investors, bought out deals poses low risk since the sponsors have already held the shares for a certain period and the projects might have been completed or in the verge of completion. The investors need not wait for returns. But the main disadvantages of bought out deals is sponsors are able to create a positive image about the shares and sell them at a hefty premium. Single investment banker gives scope for manipulation of the results, and insider trading and price rigging could be carried out, which can neither detected nor penalized. Private placement. Rights issue. So, as I already told about rights issue, according to Section 81 of the Companies Act of 1956, if a public company wants to increase its subscribed capital by allotment of further shares after 2 years from the date of its formation or 1 year from the date of its first allotment, whichever is earlier, it should offer share at first for the existing shareholders in proportion to the shares held by them at the time of offer. The shareholders have no legal binding to accept the offer and they have the right to re-announce the offer in favor of any person. Shares of this type are called rights shares and they are offered at an advantage rate compared with the market rate. But the company has to satisfy certain conditions to issue rights issue according to Section 81 of the Companies Act. That is, right shares must be offered to the equity shareholders in proportion to the capital paid on those shares. A notice should be issued to specify the number of shares issued. The time given to accept the right offer should not be less than 15 days. The notice also should state the right of the shareholders to re-announce the offer in favor of others. After the expiry of the time given in the notice, the board of directors has the right to dispose the unsubscribed shares in such a manner as they think most beneficial to the company. So students, hope you understood about the different types of placements in the primary market, its advantages and disadvantages from the point of view of the company as well as the investors. Thank you for listening.